Welcome, curious minds, to another deep dive. Today, we're cutting through some of the noise surrounding a topic that honestly shapes almost everyone's financial future. Deferred compensation. Now, it might sound like something just for, C-suite executives, but trust me, if you're building wealth for the future, maybe through a 401k, an IRA, even stock options, well, you're already in this world. Our mission today, uncover the really impactful strategies, shed light on those hidden opportunities, and maybe challenge some conventional wisdom about managing your money, especially when it comes to taxes. We'll be looking at everything from your personal retirement accounts to employer plans and those intriguing non-qualified arrangements too. So let's dive deep and unlock some valuable insights.
Okay, let's kick things off with maybe the most personal, the most fundamental retirement tool for many of us. The individual retirement account, or IRA, is often that first step, right? Taking control of your own saving strategy.
That's right. And what's truly foundational about IRAs, I think, is that they empower pretty much all workers to save for retirement. Doesn't matter if you have an employer plan or not. It's like a universal starting point.
And when we talk IRAs, the two big players are always the traditional IRA and the Roth IRA. For our listeners who are pretty savvy, what's the core strategic choice here? It's not just about which one sounds better, is it?
No, not at all. It's fundamentally about managing your tax bill. Are you paying taxes now or are you paying them later? With a traditional IRA, you often get that immediate tax deduction for your contributions, which means, you might pay less in taxes today.
Okay, so a potential break now.
Right. But the trade-off is when you eventually pull that money out in retirement, those distributions are generally taxed, ordinary income. Though here's a detail often missed. If you made non-deductible contributions over the years, well, a portion of your withdrawals later will actually be tax-free. It's a return of your capital.
Oh, okay. So tax break going in, taxes coming out, but with that little carve out for non-deductible money. Good detail. And the Roth IRA, it's basically the reverse situation.
Precisely. Yeah, Roth IRAs flip that completely. You contribute money you've already paid taxes on, so no immediate tax deduction.
Right.
But the really powerful benefit, the big win, is that all qualified distributions in retirement are completely tax-free. Every dollar of growth, all the earnings, it comes out clean, no tax bill, which makes them super attractive if you think you'll be in a higher tax bracket down the road.
That is a huge strategic point. So the choice really hinges on predicting your future tax situation. And what are the current contribution numbers people should keep in mind for 2024?
Okay, so for 2024, you can put up to $7,000 into an IRA. If you're age 50 or older, you get that extra $1,000 catch-up contribution. And for couples saving together, spousal IRAs let you double that, up to $14,000 combined. But it's really important to remember Roth IRA contributions. They can phase out based on your income, your adjusted gross income, so you definitely need to check those income limits.
Good point. Now, beyond just putting money in, people often need to move funds around. Changing jobs, refining strategy. We hear terms like rollovers and conversions. What's the practical difference? Any traps to avoid?
Okay, so think of a rollover as just moving your money from one retirement account to another, like from an old 401k to an IRA, without triggering taxes right now. The key is you got to complete it within 60 days if the money comes to you first. Or even better, do a direct trustee-to-trustee transfer, where the money goes straight from institution A to institution B.
Ah, so it never actually hits your personal bank account.
Exactly, and that direct transfer. It neatly sidesteps the one IRA rollover per 12-month period rule, which honestly trips up a lot of people who try to handle the check themselves.
Okay, so direct transfer is the safer bet. Got it. What about a conversion then? That sounds more like a deliberate move.
It is. A conversion is very specific. You're moving assets from a traditional IRA to a Roth IRA. Now, this is a taxable event. It happens in the year you do it because you're essentially taking pre-tax money and putting it into that tax-free growth bucket.
Yeah.
But it's a really powerful strategy, especially if you think you'll be in a lower tax bracket for a particular year, maybe early retirement or a gap year.
So you pay the tax now at potentially a lower rate to get tax-free withdrawals later.
Exactly. You lock in that tax-free status for life. And here's a neat little safety valve. If you convert, and then maybe the market tanks or you just change your mind, you can actually recharacterize it. Basically, undo the conversion, move it back to a traditional IRA, as long as you do it by your tax return deadline.
That recharacterization option sounds like a really crucial escape hatch. And I heard about a recent kind of interesting update related to 529 education accounts. That could be a game changer for some families.
Oh, absolutely. Yeah, that's a recent change from the Secure Act 2.0. It allows beneficiaries of 529 college savings plans to actually make direct rollovers into a Roth IRA. This is huge for families maybe with leftover funds, money not needed for tuition. Instead of pulling it out and facing taxes or penalties, you can repurpose it for retirement savings. A very specific but potentially powerful planning tool.
Interesting. Okay, circling back to traditional IRAs for a sec, let's talk required minimum distributions, RMDs. What's the deal with those, and what happens if you forget to take them?
Right, RMDs.
Yeah.
Basically, the IRS saying, look, you've had this tax deferral long enough,
Huh.
time to start taking money out and paying taxes on it. They typically kick in the year you turn 73, and failing to take them, that's a serious mistake. It can lead to a pretty hefty excise tax on the amount you should have taken out. We're talking 25% potentially.
Wow, 25% is not small.
No, it's not just a slap on the wrist. It's designed to make sure those funds are actually used for retirement, not just passed down tax sheltered forever.
Oh,
Oh, and also be really careful about prohibited transactions. Like, don't borrow from your IRA or use it as collateral. That can blow up the whole account, make it taxable, penalties. Just don't do it.
okay, good warnings. Now, moving from the personal side to the professional, many of us also have deferred compensation through our jobs. Let's get into employer-sponsored retirement plans. What makes them tick?
Right. So when we look at employer plans, the really fundamental split is between defined benefit DB plans and defined contribution DC plans. And even though our audience knows this stuff, a quick refresher, I think, highlights the key difference in who's taking the risk.
Absolutely. It's all about who bears that investment risk, isn't it?
Exactly. So defined benefit plans, think traditional pensions. The plan defines a specific benefit you'll get in retirement, like, say, a fixed amount per month for life. The employer takes on all the investment risk. They have to make sure the money's there to pay that promised benefit. You don't have your own separate account balance, really. It's a promise from the company.
So the company guarantees it. They handle the ups and downs of the market for you.
That's the idea. Now, defined contribution plans, they're different. They define how much the employer, and often you too, will contribute to your individual account. Your retirement benefit then depends entirely on how much goes in and how well those investments perform over time. You bear the investment risk here.
Hmm.
But the flip side is you usually get more control over how it's invested.
And the most common DC plan, the one pretty much everyone knows, is the 401k. Let's unpack that one.
Right, the 401k. It's really designed to make retirement saving accessible and, tax advantage through work. And just like with IRAs, you can have a traditional 401k. Or, if your employer offers it, a Roth 401k.
And the tax treatment basically mirrors the IRAs we just talked about. Pre-tax for traditional, after-tax for Roth.
Yep. The underlying tax philosophy is very much the same. Traditional 401k, pre-tax contributions, your money grows tax deferred, and then distributions in retirement are taxable. Roth 401k. You contribute after-tax dollars, but then you get tax-free growth, and if you follow the rules, qualified tax-free distributions later. It's that same critical decision point. Pay the tax now or pay it later. Depends on where you think your tax rate is headed.
Got it. So what about the contribution limits for 401k? And what's that crucial bit of free money everyone should absolutely grab?
Okay, limits for 2024. Employees can put in up to $23,000. Elective deferrals, they call it. And if you're 50 or older, you get that extra catch-up room, another $7,500. But the real game changer, the thing you just cannot leave on the table, is the employer match. Many employers will match your contributions, often dollar for dollar, up to a certain percentage of your salary. It's literally free money for your retirement. Not taking full advantage of the match is probably one of the biggest financial mistakes people make.
It really is just leaving money behind.
Absolutely. Oh, and another recent change, thanks again to Secure Act 2.0, participants can now, for the first time, designate employer contributions, like the match, as Roth contributions, provided you're fully vested in them, of course. This opens up even more potential for tax-free growth down the line.
Wow, a Roth match. That's a really interesting new wrinkle. Now, what if you're, say, ambitious, you change jobs mid-year, and you accidentally contribute too much across different 401ks? Is there a fix for that?
Yeah, that happens. It's called an excess elective deferral or an over-contribution. If that happens, your employer, or maybe your new employer, can give you back that excess amount plus any earnings on it. But you have to get it done by April 15th of the following year. If you miss that deadline, well, then that excess amount gets taxed in the year you contributed it, and it gets taxed again when you eventually take it out of the plan. Double taxation. Definitely something to avoid.
Ouch. Okay, so timely correction is key there. Now, to make sure these plans are actually fair and benefit everyone, not just the top execs, employers have to follow some pretty strict rules, don't they?
Exactly. These are the qualification requirements. They're there to prevent the plans from being abused and to ensure they cover employees broadly. For instance, there are non-discrimination rules. These basically say the plan can't disproportionately favor the highly compensated employees, the HCEs. Benefits based on salary are generally fine, but you can't set up rules that just benefit the bosses.
Makes sense. So everyone gets a fair shake. What about just getting into the plan? Eligibility?
Right. There are also participation and coverage rules. Generally, an employee has to be allowed in if there's 21 and have completed 1 year of service, usually defined as working 1,000 hours. And the plan itself has to cover a certain percentage of the non-highly compensated employees relative to the highly compensated ones. Ensures it's not just a plan for a select few.
Okay. And then when does the money actually become yours? Especially the company's contributions, the match.
That's all about vesting. The vesting schedule determines when you have a non-forfeitable right to the money in your account, meaning it's yours to keep, even if you leave the company. Common schedules are cliff vesting. Maybe you're 0% vested for a few years, then suddenly 100% vested after, say, 5 years. Or graded vesting, where you vest gradually, like 20% after 3 years, 40% after 4, and so on, until you're fully vested. It's super important to know your plan's vesting schedule, so you understand how much of that employer money you actually own at any given time.
Critical detail, especially if you're thinking of changing jobs. And finally, distributions from these employer plans. Are the rules pretty similar to IRAs, like RMDs and early withdrawal penalties?
Yes, very much so. The distribution requirements often mirror the IRA rules. RMDs apply to traditional 401ks and other qualified plans. Usually starts by April 1st of the year after you turn 73 or retire, whichever comes later. Slight difference there from IRAs sometimes. And yeah, you still have that 10% additional tax for taking money out before age 59 and a half, unless you meet one of the specific exceptions. It's all designed, again, to encourage you to keep that money safe for its actual purpose, retirement.
Okay. Now, this is where things get, I think, particularly interesting for our entrepreneurs, small business owners, maybe people at the very top of their careers. What if you're self-employed? Or what if your company wants to offer something, beyond the standard 401k?
Right. For the self-employed, there are some incredibly powerful options, way beyond just a simple IRA. These let you save a lot more. Let's maybe flag two of the most popular. First, the solo 401k, sometimes called an individual 401k. This is fantastic if you're self-employed with no employees other than maybe a spouse. You essentially get to contribute as both the employee and the employer.
So you wear two hats.
Exactly. As the employee, you can make those elective deferrals up to $23,000 for 2024. Plus the $7,500 catch-up if you're 50 plus. Then, acting as the employer, you can contribute more on top of that, typically up to 20% of your net adjusted self-employment income. The total contributions from both sides can't exceed $69,000 for 2024. But still, that's a huge amount you can potentially sock away.
That is incredible for a sole proprietor, like turbocharging your savings. What's another strong option for self-employed or maybe very small businesses?
Another really popular one, maybe a bit simpler administratively sometimes, is the Simplified Employee Pension Plan, or SEP IRA. These allow employers, including sole proprietors, to make contributions to IRAs set up for themselves and their employees. It avoids some of the complexity of a full 401k. The maximum contribution is also substantial, up to $69,000 for 2024, generally calculated as up to 25% of compensation or self-employment income. So simpler to set up and run than a 401k, but still offers really high contribution potential. While Keogh's and simple plans also exist, the solo 401k and the SEP IRA are often the heavy hitters for many self-employed folks.
Okay, great options there. Now, shifting gears a bit, let's talk non-qualified deferred compensation plans, NQDC. These sound like, well, a different animal entirely. Often used by executives, right? Why choose one of these over just maxing out a 401k?
Yeah, NQDC plans offer a lot of flexibility, especially for high earners who've already maxed out their qualified plan contributions, like that $23,000 in the 401k. The main appeal is the ability to defer paying federal income tax on compensation until a later date, usually retirement, when, the hope is you'll be in a lower tax bracket. What's really key here is that the employer's tax deduction for that compensation is also delayed. They only get the deduction when the employee actually takes the income. It's basically a contractual promise from the company to pay you later. But crucially, often without the same legal protections as a qualified plan like a 401k.
Okay, so attractive for tax deferral, but maybe riskier. I've also heard some kind of surprising things about golden parachute arrangements that fall under NQDCs. They can have some pretty hefty tax consequences.
Yes, golden parachutes. These are those agreements that promise big payouts to key execs if they lose their job because the company changes ownership, like in a merger. And yeah, the surprising part, or maybe the cautionary tale, is this. If that payout is tied to the ownership change, and it equals or exceeds 3 times the employee's average annual pay, then the company can actually be denied a tax deduction for the excess part of that payment, the amount over 1 times average pay.
Okay, so the company loses a deduction.
Right. But here's the real kicker for the employee. The person receiving that excess parachute payment, they get hit with a stiff 20% excise tax on that amount, on top of regular income tax. So it really raises questions about, balancing those big executive incentives with some potentially painful tax costs for both sides.
Ouch. Yeah, that 20% excise tax sounds brutal.
Yeah.
What's another really critical disadvantage for the employee with these non-qualified plans?
A huge one, and one people need to be really aware of, is that NQDC plans are very often unfunded. This means the money isn't set aside in a trust for you like it is in a 401k. The deferred compensation is essentially just an IOU from the company, a liability on their books. So if the company runs into financial trouble, goes bankrupt, you, the employee, are just an unsecured creditor, standing in line with everyone else the company owes money to. There's no guarantee you'll get paid.
Wow. That's a significant risk compared to the protections in a qualified plan. Okay, let's pivot one more time. Let's talk about another common form of deferred comp, especially big in tech and startups. Stock options. What exactly is a stock option, just at a basic level?
Sure. So at its core, a stock option gives you the right, but importantly not the obligation, to buy a certain number of shares of your company's stock. You get to buy them at a fixed price. That's called the option price or strike price. You have a specific time frame to do it. The whole idea is to give you a stake in the company's success. If the stock price goes up above your option price, you can potentially profit.
Right, aligns incentives. And just like IRAs, there are two main flavors here with really different tax treatments. Incentive stock options, or ISOs, and non-qualified stock options, NQSOs. And understanding this difference, I gather, is crucial. It can save you or cost you a lot in taxes.
Absolutely. This is where the tax details get particularly nuanced. Let's start with incentive stock options. ISOs. Generally, when the option is granted to you, there's no immediate tax hit. Not for you, not for the company. But the tricky part comes when you exercise the option, when you actually buy the stock. That difference between the stock's fair market value on exercise day and your lower option price. That's called the bargain element, or the spread. And that spread is an adjustment item for the alternative minimum tax, the AMT.
Ah, the dreaded AMT. So you could owe tax even though you haven't sold the stock yet, just for exercising.
Exactly. It's phantom income for AMT purposes, and it catches a lot of people by surprise. The potential big tax benefit of ISOs, though, comes later if you meet specific holding period rules. You have to hold the stock for at least 2 years after the option was granted AD, at least 1 year after you exercised it.
Okay, 2 holding periods to track.
Right. If you meet both. Then, when you finally sell the stock, your entire gain from the option price up to the sale price is generally taxed as a long-term capital gain, which is usually a much lower rate than ordinary income tax. That's the big payoff for ISOs, or a trade-off for the company. If you get that favorable long-term capital gains treatment, the company generally doesn't get any tax deduction related to the option.
Okay, so ISOs. Potential AMT headache on exercise, but potentially great long-term capital gains treatment on sale if you hold it long enough, and no deduction for the company. What about the other kind, non-qualified stock options and QSOs? Are they simpler?
They are generally more straightforward, yes. The tax event usually happens earlier and is less complex, though often results in ordinary income. If the NQSO has a readily ascertainable fair market value, unquote, when it's granted, which is rare, unless it's like an option on publicly traded stock itself, then you actually recognize income right at grant. But much more commonly, especially with private companies, the option doesn't have a readily ascertainable value at grant. In that case, you don't have a tax event until you exercise the option.
Okay, so tax hits upon exercise for most NQSOs.
Correct. At exercise, the spread the difference between the stock's fair market value and your option price is taxed to you as ordinary income. Wages, basically, subject to payroll taxes too. And at that same time, the company gets a tax deduction for that same amount. Then, when you eventually sell the stock you acquired, any further gain or loss from the exercise date price is treated as capital gain or loss, short-term or long-term, depending on how long you held the stock after exercise.
Okay, so NQSOs. Usually ordinary income tax on the spread at exercise, company gets a deduction then too, and then capital gains rule is applied to any later appreciation of the stock itself.
Exactly. Generally simpler timing, but the income recognition at exercise is typically ordinary income, not the potentially favorable long-term capital gains you might get with an ISO.
Yeah.
And, for both types, it's crucial to remember. Options are great when the stock price is rising, If the stock price falls below your option price, they can become underwater or worthless. There's real market risk involved.
Absolutely. Okay, wow. We have covered a ton of ground today, from personal IRAs all the way to complex executive comp and stock options. So let's try to tie this all together. What does this mean for your personal financial strategy? What are maybe the biggest, most actionable takeaways people should really be thinking about?
Well, if we connect all these different pieces, look at the big picture. The ultimate goal is always maximizing your after-tax wealth over your lifetime, right? So first, qualified plans, your 401k, maybe a Keo if you're self-employed, they are just invaluable for most people. The tax deduction upfront or tax-free growth, plus the employer deduction, it's a huge advantage. And for younger folks who might move jobs more often, those defined contribution plans offer that portability and control.
And that constant question, traditional versus Roth, for both IRAs and 401ks, how do you make that call strategically?
It really boils down to your best guess about your tax situation, now versus later. If you genuinely believe your tax rate is lower now than it will be in retirement, then the traditional, with the upfront deduction, looks appealing. But if you think you'll be in a higher tax bracket later, or you just really value the certainty of tax-free income in retirement, maybe avoid RMDs on the Roth IRA, then the Roth is often the clear winner.
Yeah.
And this, raises that important strategic question. If you have significant traditional IRA or 401k balances, should you look for opportunities, maybe in lower income years, to convert some of that to Roth, paying the tax now to secure tax-free income later?
Right, proactively managing those future tax bills through conversions. Makes sense. And for most employees, assuming they have access, the 401k is almost always going to be better than just relying on an IRA, isn't
Oh,
it?
for sure. Generally, yes. A 401k is usually far more attractive. Why? Much higher contribution limits, first off, $23,000 versus $7,000 for 2024 before catch-ups. And crucially, that potential for the employer match, which again is free money. You just don't get that with a standard IRA.
Okay. What about those non-qualified plans, the NQDCs, for the high earners? What's the bottom line strategic takeaway there?
Look, non-qualified deferred comp can be a great tool for deferring income, especially if you've maxed everything else out. But you have to be really aware of two big things. One, the potential bunching of income. If a lot of deferred comp pays out in 1 year, it could push you into a much higher tax bracket than you anticipated. And two, that risk of the plan being unfunded. Remember, you're an unsecured creditor. If the company gets into trouble, that deferred money could vanish. That's a real risk you have to weigh.
Definitely need to understand that credit risk. And finally, stock options, the key strategic thought.
Stock options can be powerful, no doubt. But understanding the detailed tax differences between ISOs and NQSOs is absolutely critical. Making the wrong move on when to exercise, when to sell, or misunderstanding the AMT implications with ISOs or the ordinary income hit with NQSOs, that can lead to some very nasty tax surprises. It's really an area where getting specific expert advice based on your situation is often money well spent.
Absolutely. Now, here's something really fascinating, something I know challenges a lot of the old advice. The order in which you should ideally withdraw your retirement money. I always kind of thought there was a standard playbook for that.
Yeah, the traditional wisdom, what you often heard was spend your taxable brokerage accounts first, then tap into tax-deferred accounts like 401ks and traditional IRAs, and save the Roth IRAs for last. The logic was ROCs grow tax-free and don't have RMDs for the original owner, so let them compound as long as possible.
All right, that sounds familiar.
But newer research and more sophisticated planning suggests that rigidly following that sequence can actually be pretty tax inefficient. Why? Because you might end up wasting your lowest tax brackets in many retirement years. You have taxable income space going unused while your tax-deferred accounts just keep growing, potentially pushing you into higher brackets later when RMDs kick in.
Okay. So what's the smarter approach then?
Well, a more tax-efficient strategy for many people actually simplifies things. Maybe counterintuitively, it's kind of a two-pronged approach, especially in early retirement. Yes, spend from your taxable accounts, but at the same time, strategically accelerate income from your tax-deferred accounts. Do Roth conversions. Make strategic withdrawals from traditional IRAs or 401ks. Enough income to fill up those lower marginal tax brackets each year, maybe the 10%, 12%, even the 22% bracket. You pay some tax now, yes, but at those relatively low rates. This proactive approach can significantly reduce your total lifetime tax bill compared to just letting those tax-deferred accounts grow unchecked until RMDs force huge distributions later at potentially higher rates. It gives you more control.
Wow. That is a genuinely different way of thinking about withdrawal strategy. Proactively realizing income at low rates instead of just deferring everything as long as possible. What an incredible deep dive this has been into the whole world of deferred compensation. From really getting the nuances of your everyday IRA to navigating those complex employer plans, stock options, you should now have a much clearer map for making smarter choices and maybe questioning some of that old advice. And here's maybe a final provocative thought for you to chew on. If strategically timing your income, pulling levers like Roth conversions, can genuinely lead to substantial tax savings over your lifetime, what small intentional steps could you take, starting maybe even today or next year, to truly optimize your own future tax landscape? Are you potentially leaving tens, maybe even hundreds of thousands of dollars on the table over your retirement by not thinking proactively about this stuff, by not grabbing every matching dollar, or by not considering those strategic Roth conversions when the time is right? Just something to think about the ripple effect those small actions could have. Thank you so much for joining us on the deep dive. We really hope this knowledge empowers you to build a more secure and definitely a more tax efficient financial future.